Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is entrepreneur and real estate expert Colby Culbertson. Now, Colby is the president of Culbertson Holdings, an investment firm focused on value-add investments across both the real estate and energy sectors. Colby has an extensive background in identifying profitable investment opportunities, arranging for debt and equity solutions, as well as running point on allocating investor capital into strategic alternative investments. And so without further ado, I'd like to welcome Colby to the show. Colby, how you doing today?
Hey, I'm doing well, Kevin. How about you?
I'm doing fantastic. Excited to have you here. Excited to peel back the layers and learn a little bit more about you and your business and what did you do. And so, I'll give you a very short introduction there. Maybe take a few minutes, Colby, and in your own words, we'd like to learn a little bit more about you, your background, and what did you do in the real estate world.
Yes, sir. Well, first and foremost, really appreciate you having me on, Kevin. From the outside, got a great platform, been doing it a long time. So, feel great about being here. Background about myself, Colby Culbertson here in Dallas, Texas, owner of Culbertson Holdings. Over the last 4 or 5 years, I have been directly affiliated with organizing capital, ground up construction, value add renovation, various takeout refinances, inclusive of a myriad of different types of JV with private capital, and taking a really hard look at various asset classes, inclusive of residential and alternative residential assets, multifamily, mobile homes, even more creative stuff like RV parks. And then kind of tailoring through industrial, going down that list as well. So very agnostic when it comes to asset classes. The type of capital that's available right now is very hyper focused on specific lanes, whether it's multifamily, mobile homes, self-storage, or whatever that is. So I try to use that information to be as effective and resourceful as possible to the Kevins of the world and other investors that are looking to get into the market or, buy a property right, which is, really the best way to do it really ever, but now more than ever.
Yeah, no, I agree with that statement there. So would love to maybe get you through your lenses. Existing clients that maybe you have been working with for a few years. What's the landscape look like? Again, we know that it's very different today than what it was a year and a
Sure.
half ago before the Feds really started making the numerous rate hikes. And again, transactional volume is down. And so just what are you seeing? Is it a bloodbath? Is transactional volume completely halted, or deals still being done? If so, like, just what's that look like? What does a deal look like today?
Sure. That's a great question. And I'll answer it in two different ways. Call it back in 2019, 2020, lenders were not as focused on the downside because let's face it, we've been pretty much linear for the last decade, which ultimately is kind of given a little people some kind of false confidence. Getting that 75, 80% leverage, doing the full term interest only, or maybe the bridge loans that had some type of rate cap or maybe none. Which has really allowed a lot of sales brokers like investment sales or investors to purchase properties maybe a little bit outside of what the market was at the time. And now, kind of proceeding a couple of years later, I think people are starting to kind of feel the burn a little bit. Folks that did buy at 80% outside the market, when they're trying to identify some long-term products, and they're having to either come to the table with some cash or sell, frankly. So I think the way that deals were getting done back then were to lever up as much as you possibly could because there's only one way but up. That was kind of the sentiment there. But here we are now with the Fed tightening up, with cap rates kind of compressing a little bit. I'm sorry, yeah, I guess depending on what the cash flow looks like, but there is a lot more equity that needs to be going into deals. Lenders are wanting people to have more skin in the game, which is requiring guys to raise more money or bring more money into the deal, which really does affect the return model that people are used to.
Yeah. Have you seen any clients that you've worked with over the last couple of years that are completely out of the buy box today? I mean, they're kind of on the sidelines for XYZ reasons, or most of the folks that you've dealt with still active in today's marketplace?
I'd say it's a little bit of a combination of both, but I would say the front end of that is probably the better reality because, hey, look, a lot of people are it's not like they're not looking at deals, right? Everybody is still taking a look at deals. They're staying in contact with the resources, their investment sales guys. It's just that the sales expectation versus where rates are at today, and then also just better understanding what's at the end of that rope. Because if investors today are identifying, a lot of what I do, which is short-term bridge private capital, it still only has 12, 24 months, maybe 36 months on that term. Not a lot of facts have been provided in the marketplace to give someone a comfort level that the rates are going to be a little bit more attractive in 12 months from now. And this at this juncture, I do think we'll be in a better place, but it's nothing's guaranteed. And I think a lot of the investors, especially the savvy ones, are just trying not to get ahead of the curve too early and jump into something that they may, regret here in 12 months or so.
Yeah. So, bridge debt was always, the more expensive debt, but, along with that expense came flexibility. Are you,
Sure.
I guess, is that still a viable option in today's world? I mean, you still seeing bridge deals get done, or are folks taking more of a conservative approach and just maybe locking in some, 5 year, assuming the deal, calls for it, but locking in some longer term, maybe 5, 7, or 10 year Fannie or Freddie debt right out of the gate?
So Fannie is still pretty competitive.
Yeah.
I mean, right now we're still pricing Fannie Mae low sixes. Just not too recently was kind of in the high fives, but it does come with the caveat of a yield maintenance or some
Mhm.
type of stringent prepay. So does it really make sense to ride out 60 months when all roads lead to a better environment, probably within 24 months? That's the question that a lot of investors are asking themselves or going to
That's
committee with.
That's the
Where I
multi-million
think
dollar
that
question. Yeah, that is the
that's right.
multi-million
That's
dollar
right.
question right there. Go ahead.
And
Sorry, didn't mean to interrupt you.
no, you're good. You're good. It's a great point. And I think on the flip side with the bridge, it kind of goes hand in hand with that same sentiment. It's like, hey, look, are we willing to pay the SOFR plus 5, SOFR plus 4, eat that cost for say 12, 24 months, but also paying for the rate cap, which is now definitely a requirement. And it's not cheap either, Kevin.
Yeah.
Those guys are making their hay right now. And it really just boils down to your total cost of capital, inclusive all those soft costs, and what the expectation is at the end of that road. Are you going to build in an extension? Are you going to pay for that extension, which is typically 1 point on that loan amount? And if it's interest only, it's just the same cost, right? And that's also if you didn't exhaust some of your capex, which ultimately could be paying a little more as well. So it really depends on your exit. So I really try to preach exit strategy. How long are you going to be in this deal? What's your expectation on your exit, and what does that look like? And that's the biggest way for me to kind of, really kind of bottleneck that conversation with discussions of either going long term or a short term product.
Yeah. How about let's talk about maybe the shift from the lender's eyes. How have the programs changed generally speaking? I mean, requiring more equity into the deal, more skin in the game. But are there any other additional nuances that they put in as protection layers for themselves as it relates to borrower track record, just the history of the deal as far as maybe what do the rent increases look like over the last 3 or 4 years? I mean, there are any other aspects that are coming into the question today that might not have been brought up prior to?
Yeah, and I would say, as far as the investor is concerned, they're certainly looking at relationships, especially with banks. If you go to a bank today and you're expecting a transactional conversation, you're probably going in the wrong direction.
Yeah.
Most conversations I'm having with banks now are requesting either a full turnover of your operating accounts and your business account to that bank, or a pretty aggressive ask as far as starting some sort of depository relationship, which 2 years ago today would probably have been just transactional with that particular deal, having an operating account there. Whereas now it's much more long-term focused. Hey, look, if we're going to take our dry powder and give it to you, what is that worth to us? And that's how banks are kind of viewing that. With bridge lenders, given that the cost of capital is much higher and the rate caps and everything like that, they're looking at post-close liquidity now more than ever.
Mhm.
That 5% post-close, 10% post-close liquidity, and that's after down payment and closing costs and everything. They're now kind of wanting like 10 to 15, if not 20%. cumulative liquidity between the sponsors. And also to your point about experience, they're not exactly taking risks on guys that have never done it before. You're going to have a level of a track record that, you schedule a real estate. What's that look like as far as, how much variable debt do you have? How much recourse debt do you have? How much supplemental income do you have? Those are all variables that I think weren't necessarily as a stringent discussion topic, but now has become a little bit more under the lens in conversations.
Are we speaking more from the side of a traditional bank, full recourse loan, or are you saying that's more across the board, even with agency lenders, CMBS, what have you? Have all those changes occurred? Maybe not
I
the
would certainly
not the
say
depository relationship. Obviously, that doesn't
right.
necessarily relate to agency or CMBS or life co's, but just the other aspects there. I mean, has that changed across the board for the most part?
So here's the thing with like Fannie Mae and CMBS, given that it is non-recourse, they will give a level of kind of a benefit of the doubt. But liquidity certainly needs to be there. They want to make sure that they're not going to have some type of event where they have to, start talking about capital calls or taking the property back. That goes back to the management strategy as well, too, Kevin. Right? What does your pro forma look like? Do you have the cash necessary to stabilize this property or take it through the length? So I would believe that agencies are going to be pretty programmatic. That's why people like using agency, because it is a regulated program. It's a box, right? Whereas some of the CMBS lenders, with CMBS, it's ultimately like a professional syndication because they're just going out to the market and raising capital in a very professional, dialed in way. That's what CMBS is. That's why you can be creative with it, but also too, because there is that level of syndication with the lender, they're going to be pretty stringent on who they're borrowing to. Loan amounts are higher. Their debt yield is much higher now, which the debt yield is how much money they're making. So essentially they got to make it worth it for them on the CMBS side. So I think kind of circle back on that real quick. The changes that I've seen are obviously the leverage points, the aggressive valuations are really coming to a halt, and being able to have a little bit more dollars into the deal. And then some of the other more private capital institutions are really heavy on liquidity and experience.
Mm-hmm. How about life co's? Where are they at in the lending scheme of things nowadays? Are they still active? Have they pulled back a little bit?
Would definitely say they pulled back. I really like Life Goes because they can be agnostic on asset classes. Their pricing is very similar to like agencies, for example. I would really compare kind of Fannie Mae, Freddie Mac pricing to Life Goes, except the leverage point. I mean, they are risk. That's what they do every day. Life insurance, all it is risk. So they're going to be very careful on the type of leverage that they're going to be putting forth. But call it 2-3 years ago, some of my best lenders were life co lenders that are, above 5 million, 10 million and up. But I would definitely say they're a little bit more risk averse, and that's just what they do for a living, even outside of the lending environment. Right.
Mm-hmm. Yeah, no, I agree. So your crystal ball and those that you surround yourself with, the other experts within your industry that you rely upon and just share knowledge with, where are the indicators pointing? You'd mentioned 12 to 24 months. More than likely we will probably find ourselves in a interest rate environment that is hopefully lower than what it is at present time. But just can you add some more context? And I know there's no one's an expert. I mean, no one knows the absolute answer here. No one can tell the future, but just from your perspective, what does that look like?
Yeah. I think, given that election year is coming up, the unfortunate truth is that there's probably a can of worms somewhere that we're not really expecting. Let's look back at 2020, that election
Sure.
year, and the microeconomics that happened
Mm-hmm.
due to some of the COVID and everything else. I think that with the everything going on in the world right now, not to get too deep into that, but I do think that there's going to be some type of event where rates may not be the only factor that may slow down the marketplace, whether that's war, whatever that may be. But I think from a rates perspective, historically speaking, on an election year, we usually have a dip in rates somehow, some way. they'll likely use it as a benchmark or a campaign trail for the people. This is what we're doing for you. So I think there's going to be a positive softening from a rates perspective next year, and it'll slowly start to dwindle down, especially as we kind of get in front of inflation. I did see an article this morning in respect to this specifically, saying that we don't anticipate any additional raises, but we could be holding where we're at for a bit longer, with anticipation for, say, after February leading into Q2 to start seeing some relief from rates.
So what type of activity are you seeing from, again, speaking to your clients? I mean, those that are buying, are you seeing that, in their opinion, it's a great time to buy, that they're finding opportunity? If they've got the equity available, and they've got the long-term horizon that they're looking at, are you finding that they're being active if deals are present, or is it quite the opposite? I can speak for my own. I'm starting to see some pricing expectations be reset from the seller side, and that took quite some time for that to actually occur. And we're personally seeing that there's some opportunities that are being priced pretty fairly, solid opportunities that probably a year ago we wouldn't have made it to final and best round on. We wouldn't have been competitive. We were pretty conservative by nature. But we bought a lot slower over the last 3 years than maybe what a lot of our competitors have, and so I think it's given us an open opportunity to now participate, while some others are maybe playing damage control, maybe dealing with debt maturities or expiring rate caps, what have you. And so I just curious to hear what maybe you're seeing with your clients.
Yeah, absolutely. And you make a lot of good points too. I mean, I think the way that sellers are viewing their deals going to the market are maybe a little bit more lenient now. When I say lenient, before all they had to do was put a price tag on it and make it for sale, they'd probably sell it.
Yeah.
Whereas now,
not a price tag.
yeah, exactly.
Let the market
Not disclosed, just, and then that price battle of call for offers. Before that used to be a nightmare for a lot of guys, especially in states like Texas and Florida, some of the highest activity in those two states. So I used to see guys, getting very frustrated with the call for offers and, either making it, not making it, and then price battles going up and up. And now it's just not the case. A lot more diligence has to go into the underwriting, a lot more flexibility with the seller. I think buyers are starting to be in the driver's seat a little bit more. And, kind of going back to my point before, it really depends on what the management strategy is. Are they going to go in? Is there a ton of CapEx that needs to be done? Physical cost is not as much of a value add, in my opinion, these days, because cost is so high. Rent growth has slowed to a degree due to the amount of supply. And then if you're expecting just a refi into something extremely competitive in a year from now, who knows if that's the reality? So
yeah,
I'm seeing guys get into deals, but to your point, it's not at an inflated over the market window. And it really depends on the kind of financing they're getting as well. I'm seeing guys come in the door with 35%, sometimes even 40, getting 60%. But also, obviously, there is opportunities for much less, higher leverage, if you will. But as long as they're comfortable with going out there and raising additional capital, that's really where guys are kind of getting ahead of the curve when they have that type of network and they're able to get, buy it right. The big variable that I like to use is yield on cost. An 8% yield on cost is kind of a target market for a lot of the experienced guys that are coming in as JVs or co-GPs or whatever that may be. I would imagine that translates pretty well with a lot of the LP guys out there that are looking to, participate in some of these raises as well.
Yeah, no, I agree with you. So Colby, for those that want to learn more about you and your company and the different services you provide, like, where's the best place to track you down?
Yeah, absolutely. So my email is relatively easy. It's just my initials, CC at culbertsonholdings.com. And my LinkedIn, I'm very active on LinkedIn, linkedin.com/ColbyC. And we will be happy to connect with anybody and chat a little bit more on what we're seeing and how I can help you out.
All righty, good deal. And just a reminder on sense of geography, you're in the Texas market. What part of Texas again?
Yes, I'm in Dallas, Texas.
Okay.
We do have a nationwide scope though. I've closed in pretty much every state you can think of, except for Alaska and Hawaii, which still unsure if that will happen, but I'm sure we could get it done if the opportunity arose.
Just a matter of time. Just a matter of time.
That's right. That's right.
Well, Colby, I appreciate you coming to the show. It's been a lot of fun having you, my friend.
Hey, thank you, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.